Hello everyone, it's the weekly market update. I'm Charles Brown, portfolio manager with CB3 Financial in Chicago. We're glad you're with us. Yesterday was a market holiday, as you know, but there was a lot going on last week and a lot expected to happen this week. We'll get right to it. Whether you're managing your own portfolio or following the world's financial pulse, let's dive in. The CB3 weekly market update begins now. Last week, global equity markets faced renewed volatility and a distinct shift in sentiment downward as U.S. stocks led the retreat over the European and Asian stocks, with the S&P down 2.6%, the Dow down 2.5%, and the Nasdaq also down 2.5%. Small and mid-cap stocks fared even worse, reflecting broad-based risk aversion. Now, there's going to be a turn in that sentiment, and I'll get to that in just a few minutes. The S&P, as of this morning, now sits about 5.6% below its all-time high set just 3 months ago. We know that this volatility is because of the Trump tariff tantrums, and that's what's causing this anxiety, and it ebbs and flows depending on what Mr. Trump does or what executive order he signs. But it wasn't just stocks. Bond markets were equally unsettled. Yields on the 10-year U.S. Treasury climbed to 4.51%, their highest since late 2023, reflecting concerns, of course, about the U.S. fiscal outlook because of the recent downgrade in the U.S. Treasury debt. That's going to be an ongoing challenge for President Trump with his sweeping tax cut bill, a move expected to add more trillions to the national debt over the next decade. And here, people were expecting that debt to be reduced. It looks like at this point, it's not going to be. The 30-year Treasury yield even breached the 5% mark, a level not seen for an extended period since 2007. Commodities, however, painted a mixed picture. Oil prices continued their slide down nearly 2% to just about $61 a barrel, while gold surged 5%, closing at $3,360. I'm glad we're long gold in our portfolios as investors seek safe havens. Internationally, Europe's major indices also declined, with Germany, France, and Italy all in the red. However, European equities so far this year have outperformed the U.S. markets, buoyed by early monetary easing in the Eurozone. That hasn't followed here in the U.S., as you know, because Jay Powell and President Trump are in a battle of wills, I think, and Jay Powell is not in any hurry to reduce the interest rates in America. I think that's going to play out in a different way as we move through the year. The Fed will eventually have to cut interest rates, and that will happen. No surprise here, the week's defining theme was trade tension, specifically President Trump's escalating tariffs against the European Union. Now, on Friday, Trump stunned the markets by announcing a sweeping 50% tariff on all European Union imports set to take effect June 1st. But then that later was stalled, okay? He says that he doesn't like the way the negotiations are going and a desire to rebalance what he called the one-sided trade terms. I happen to agree with this. I think that we have been taken advantage of by our trading partners, both friend and foe, for decades. But that move did rattle European and U.S. equities and triggered an immediate warning of retaliatory measures from the Europeans. However, in a dramatic turn on Sunday, see, there are really no weekends here. There are no weekends in the market because there's always something happening. But President Trump announced a 6-week delay on the tariffs, pushing the deadline to July 9 after a very nice phone call. That's a little sarcasm in my voice. After a very nice call with the European Commission president, both sides agreed to resume negotiation in hopes of avoiding a full-out trade war. Europe doesn't want that, and we don't want that either. The European Union, for its part, has offered zero tariffs on industrial goods and greater purchases on U.S. liquid natural gas and soybeans. But they remain firm on protecting key sectors of their economy. This is all about protecting local markets. We don't get to do that, but these trade partners want to do it in their countries, and it's because our economy is so much bigger and stronger than almost every other nation in the world. So meanwhile, the Trump administration stance towards China has remained combative, to say the least, with new duties on small value packages from China and Hong Kong taking effect earlier this month. And that's further complicating the global supply chain and investor sentiment. It's that uncertainty that causes the continued volatility in all the world stock markets. On the fiscal front, the House narrowly passed by one vote the Trump ambitious tax and spending bill, delivering on campaign promises of tax breaks and increased military and border spending, but at the cost of, yes, you guessed it, continuing to raise the federal deficit. The bill now heads to the Senate, where further debate will continue, and I expect this bill will pass with President Trump signing it before the end of the summer. So what do we see for this week ahead? This coming week, of course, is only 4 days. We have the market holiday yesterday. Trade negotiations will continue between the U.S. and the European Union, with the tariff deadline being pushed back to July. Markets are much stronger this morning. Nasdaq up 323 handles, up 1.15%. S&P up 1.41%, the futures in the early market, and the Russell up 1.6%. So that's all positive. Markets like it when there is less uncertainty. I can't really say markets like certainty because there's nothing certain when it comes to these trade negotiations. But until major trading deals are done with our European partners and Asian partners, you're going to continue to see this market volatility, in my opinion. There's key economic data this week, with the U.S. including Q1 GDP revised. So that was negative for GDP in the U.S. in the first issue of this data last month. So this will be the first revision. We expect to see this remain negative, and the first quarter will show a negative print on GDP. But remember, a lot of that has to do with companies hoarding inventories, preparing for this trade war. So it's really not a true symbol of a negative quarter of GDP, in my opinion. So early estimates show a contraction in Q1 GDP, but expect a modest revision upward. Inflation data will be scrutinized for clues on the Fed's next move, with consensus now expecting rates to remain unchanged until at least December. I still think that there's a possibility there'll be a rate cut in September because of the pressure of his peers. Jay Powell sees Europe and Asian countries dropping interest rates because their economies are slowing. He is loath to do so here in the U.S., but I think he's going to have to do it. There are high-profile earnings reports this week from NVIDIA. That's on Wednesday. Dell Computer, Salesforce, and other major retailers that could provide a catalyst, especially for the tech-heavy Nasdaq. Technically, the S&P faces crucial support at 5760. I talk about this sometimes on my tweets. Follow those on Twitter, or X as they call it now, Facebook, and LinkedIn. All right, if NVIDIA delivers a knockout result, I think there's a moderate chance of testing the recent highs in the Nasdaq. That would be a positive. So in summary, last week's market action reflected a potent mix of rising geopolitical risk, fiscal uncertainty, and shifting investor sentiment. President Trump's administration continues to inject volatility into the global stock markets, and folks, we are seeing it every day in our portfolios, and investors all over the world are seeing the same thing, and they have anxiety over tariff tantrums. It eventually will pass, but right now it's still very much in play. Looking ahead, investors should brace for this continued volatility, folks. It's not going to change this week, and monitor these key economic and earnings reports that I've just mentioned to get a clue of what we expect to see over the course of the rest of this quarter, taking us through June 30. So there it is. That's the weekly update. I think we're positioned well in our portfolios. I hope that you are enjoying the data that we're providing here. If you are a client, we have our first dedicated client update at the end of this month, which will be this coming weekend. Thank you for joining me for CB3's weekly market update. We'll see you next week.